we go. Awesome. All right, guys. Look, thanks everyone for coming today. So today we're going to be running a very exciting topic, very close to my heart, superannuation. It is confusing, for a lot of people, and it's confusing even for us sometimes as financial advisors. And then when you add in the extra level of living overseas, especially in the USA, it becomes even more confusing to a lot of people. So today we're going to go through just the basics of superannuation, especially when you're living over in the States, the main things that you need to know. A lot of people don't think about it. They put it to the side, and it's something that you want to bring to the forefront of your mind and make sure that you are taking action on and doing all the things that you need to do necessary to be setting yourself up for the retirement that you want to have, because there's a lot of things that you can be doing. We do have Q&A going today as well too. So if you do have any questions, something doesn't make sense, you want to ask something a bit more specific, definitely put your questions in there as well. But yeah, a little bit about me. My name is Will. So I am a senior financial advisor here at Ally Wealth Management. Previously at Ally Wealth, I worked with one of Australia's leading boutique financial advice firms. They didn't specialise in expats. Unfortunately, their licensee didn't authorise them to advise expats, so it made the move over to Ally, where I can focus more on that. And previously, before there, I actually worked with one of Australia's largest superannuation companies as well too. So super kind of is my bread and butter, and I do love talking about it. Also on the call, we have Jared. Jared also works with Ally Wealth Management as well too. It is an expat himself living in Singapore. So let's get straight into it, guys, if it's going to work for me. So just a bit of a disclaimer for all the lawyers. Today's conversation, it will be general in nature and won't take into account anyone's specific personal circumstances. Off the back of today's conversation, don't rush out and, do anything crazy. We really do strongly recommend that you get some personal financial advice if you are considering taking any actions and doing anything that we talk about today. But yeah, we are obviously have prepared this presentation today, based on our knowledge and what we do within the industry, but just want to make sure that people know it won't take into account your personal circumstances, so don't go rush off and make any crazy decisions off the back of today. With the agenda, we're going to focus on quite a few things today, so it'll probably take us the full hour we estimate with the presentation. Really at a high level, the main things you need to be thinking about. So who we are at Ally Wealth Management, what we actually do, we'll cover that off right at the start. Superannuation and 401ks, what's the difference between them, how do they work, that type of stuff. Contributions, so into superannuation, both concessional and non-concessional. Investments, so how to invest your super, what are your options, what are the differences between the different types of accounts. Accessing a super, so both retirement, repatriation, what that looks like. What are the opportunities that we see at the moment? One of them currently being the weak Australian dollar. We'll focus on that, as well as tax minimisation and tax management as well. And then at the end, obviously putting that all together and how that all impacts you. So Ally Wealth Management, we are, as the name suggests, people's trusted ally when it comes to finances for Australians, both living at home and across the globe. Correct me if I'm wrong, Jared, but I think we've got clients now in about 32 or 33 countries.
Yeah, it's spot on, Will, and growing rapidly.
Yes. And the States have been a hotspot recently. We're dealing with a lot of clients over there, as well as a lot in the Middle East, actually, too, Dubai, Saudi Arabia as well. But we are holistic financial advisors. So what we do, we focus on wealth management, investment advice, personal business insurance, super, retirement planning, you name it. It's something that we can specialize in. With Australian financial advice, the way it really works is a lot of licensees won't authorise companies to advise anywhere international. So it is few and far between that you will find advisors like us that can actually specialise in expats. But it's cool, and it's a good job. And we get to talk to people all over the world and talk to people who have all these different stories. So it's quite exciting. But obviously, there's a lot of complexity when it comes to this type of financial advice. So our main process, the way that we work, it's really on 5 main steps. So step number 1, we get to know you. What are you trying to achieve? Can we actually help? What are you looking for? Step number 2, if that all goes well, we go through the fact finding. So what are the specific details in your circumstances? What are your future goals? What are you trying to achieve? Is that achievable? Is it realistic? All of those type of things. Then we go through a strategy session. And in that strategy session, what we do is we outline all the options available to you. So what would it actually look like if you did A? What would it look like if you did B? What are the differences between those? What are the trade-offs? we'll give you a detailed look at what your future could possibly be through certain different options. From there, we obviously put those words on paper into action. There is no point having a financial advice plan if you don't do anything with it, right? Words on paper aren't going to do anything for you. So we make sure that we actually take the action and we stick to those results. And then finally, obviously, the ongoing support as life changes, whether you're repatriating, move to different countries, starting a family, all of these things, we make sure that we're with you every single step of that way. So that's pretty much what we do at Ally Wealth at a very high level. Obviously, if you guys have any more questions, definitely shoot them through. So superannuation, what is superannuation? Super 101, effectively, it's Australia's retirement scheme. Right? So it's been compulsory since the early 90s. In Australia, your employer legally needs to contribute a certain percentage to your superannuation every single year. Started at about 3% in the early 90s. By July 1, 2025, that will be up to 12%. So if you make $100,000 in Australia, your employer legally needs to put $12,000 every single year into your superannuation account. Currently, the Australian superannuation industry as a whole is worth about $3.5 trillion. So it's actually eclipsed the Australian share market in total as well. So it is a massive industry with obviously comes along with that massive opportunity, but a lot of missed opportunities as well. We see a lot of people who aren't looking at their super, something you can't access for a long time, and a lot of people that don't do anything with it. And with that, they miss out on tons and tons of opportunities. So 101 super is your retirement money in Australia. So when we look at superannuation, there's two primary phases. Firstly, we have accumulation phase. Now, this is what most people are in, where you're accumulating your money. Okay, so myself, Jared, most likely the people on the call, all in accumulation phase. We're growing our money, we're accumulating that wealth and growing it up to the point where we access it and retire and start to draw down those funds. In accumulation phase, the maximum tax currently is 15% on the earnings. So if you've got 100 grand in super, it makes a 10% return, makes $10,000. The government's going to take 1,500. They'll take their 15%. However, 15% is a lot lower than the tax for most people's marginal tax rate, highest being 47%, including Medicare. So you can see there that super is a very tax-friendly way to save and invest. The downside being, though, you effectively are locking your money away. You can't access your money until we go down to the second phase of superannuation, drawdown phase or retirement. So we meet a condition of release and we start to draw down that money, usually in the form of an account-based pension. We will go through a bit more detail about accumulation phase and drawdown phase throughout today's conversation as well too. But at a high level, they're the two primary types or styles, I suppose, of superannuation accounts. You'll have accumulation, growing your wealth, drawdown phase or retirement, which is a pension account usually, which is where you can actually access that money. In Australia at the moment, to draw down your funds, most people are going to need to be over 60 years at a minimum, excluding any other circumstance like terminal illness or financial hardship. So that's the thing. A lot of people can't touch that money for quite a fair bit of time. So types of funds. Really, there's four main types of superannuation accounts. Retail funds. Now, retail funds are usually open funds. They're usually owned by financial institutions, maybe banks, AMP, IOOF, that type of thing. They provide a lot of flexibility, especially for expats. All right. When we have retail funds, because you can usually choose your investments, choose the specific topics you want to invest in, what you're investing in, direct equities, direct shares, property, these type of things, they can be really, really beneficial for expats, especially living in the States. And you'll see that as we go through the slides today. The IRS are not your friend, to put it bluntly. They want to tax you every which way they can. And the rules between the two countries are quite complex. So retail funds usually will offer the greatest level of flexibility for expats, especially living in America, to be able to choose how their funds are invested in a way that can minimize tax long term in terms of the US taxing that money. Industry funds. Industry funds are probably the most common in Australia for people living onshore in Australia. Historically, these were established for certain industries. So state employees was for state super. REST is Retail Enterprise Superannuation Trust. So that was for retail employees. CBUS was for the construction industry. Australia's largest funds are all industry funds, so Australian Super, Aware Super, and ART being the three largest. And really the way that these work are they're member-owned funds. So they don't have shareholders in the background. They're technically owned by the member. As an expat, though, these type of funds don't give you a lot of choice. And the downside in that, especially living in the USA, is the extra tax that can then apply. If you guys have ever heard of a PFIC, so we'll get to that a little bit later. Long story short, industry funds are going to be full of these, meaning that you can be paying unnecessary taxes that you really shouldn't be or don't have to be. The next is defined benefit schemes. These are few and far between. A lot of old state employees have these. They're being phased out because they were very, very lucrative. But effectively, the way they work is off a defined benefit. So a defined formula. You worked for 30 years and, your average salary was $100,000. Therefore, you get a pension of $60,000 for the rest of your life. That type of thing. Kind of similar to how Social Security works in America. So it works off that defined formula, that defined benefit that gave people a certain payout. We're seeing these less and less and less as the industry is evolving because they're usually quite lucrative because people are living so long now. These funds are paying out for 30, 40 years, whereas, it used to only be 10, 15, 20 years. And then finally, self-managed super funds. Now, as the name suggests, this is where you manage your money yourself. Self-managed super funds have a lot of flexibility. You can buy direct property. A lot of business owners have self-managed super funds. They can be very beneficial. However, they come with a lot of complexity and responsibility. The onus in a self-managed super fund is on you. If you're the trustee, if you're the owner, you're the beneficiary, the onus is on you, which means you need to do all the tax accounting, all the auditing, the investment strategy. They get very complex. With self-managed super fund for expats, especially living in the States as well, most people shouldn't have them. I'll put it that way, because the onus being on you and all the areas of control and whatnot are going to mean, again, you could be paying unnecessary taxes in the States that you probably could avoid. So self-managed super funds can be a great way to manage your own wealth if you do have that personal preference or want to buy direct property. But as an expat, you probably tend to avoid them if possible. So super obligations, employer obligations in Australia. Now, won't be too relevant, obviously, while you're living in America, but there was a few people on the poll that are repatriating within the next 1 to 2 years. When you repatriate and when you are living back in Australia and you're earning an Australian income, your employer has obligations to pay you super guarantee, so SG. As I said, super guarantee started in the early 90s. It was compulsory of 3%. At the moment now, though, it's currently 11%, increasing to 12% by 1 July 2025. So as the example states down the bottom, if you make $100,000 a year, your employer legally will need to put in $12,000 a year as well. Really cool new law that's coming into effect very soon as well is the fact that super guarantee will need to be paid at the same time that you receive your pay. At the moment, it's only quarterly. So if I get paid weekly from Ally Wealth Management, they don't actually need to put my money into my super until every 3 months. The downside of that being that money is not invested for that whole time. So there's some studies showing that for the average Australian, by making super guarantee payable as you receive your salary, could increase the average Australian's balance by retirement by about $6,000. So not a small amount of money, especially when it comes to your retirement. So next slide, very grim topic, what happens when I die, but it is quite important to think about. It's not something you want to think about regularly, but I just want to bring it to the front of the mind. And I put it in here today because superannuation, the goal of it is for it to last your retirement, right? So you can be a self-funded retiree, you can do the things you want to do. Most people, when they pass away, will have some superannuation left over. So it's really important to consider what actually happens to that money when you pass away. It's not as simple as, your home or other investments you might have. Superannuation is what we call a non-estate asset. What that means is it will not go through your estate. It will not go through your will. You have to nominate someone for your superannuation to go to. That person needs to be what we call a cis act dependent. So effectively by law, it needs to be a spouse, a child, or someone financially dependent on you. If you want it to go to your estate, if that's your wishes, and then maybe you want it to go to a charity or go to a brother or someone who's not a cis act dependent, Most funds will let you nominate what's called your legal personal representative, your LPR. In doing that, then you can pass it on to your estate. A big thing to note, and what a lot of people don't think about until it's usually too late, superannuation is very tax-friendly for you in Australia as you're growing your wealth. There is no inheritance tax in Australia. So if my mother passed away and I got her property, I wouldn't pay tax on that inheritance like you do in other countries, like the States. Superannuation, though, does have tax when it passes on the taxable component. So a portion of superannuation will be considered a taxable component. There are ways to minimize it and reduce it over time, but effectively it goes through your estate. If you nominate your LPR, you'll only pay 15%. If it goes to a child, though, or someone financially dependent, there can be up to 17% tax on that taxable component. The majority of people's funds have a high taxable component. In my career, I've seen people with most 80 or 90% of their money is in that taxable component, meaning when they pass away, their kids are going to pay 30, 40, 50, $100,000 in tax on that fund. So again, it's not something we want to think about regularly, but it is really important to have a plan in place on what that generational wealth transfer is going to look like. And if super does go to your spouse, though, there's no tax. So to a spouse, no tax, but to a child or anyone else, there will be taxes. So when you look at nominating someone for your superannuation to go through, that's called a beneficiary. There are lots of options when it comes to beneficiaries. As I said, it does have to be someone under that SIS Act. So spouse, child, someone financially dependent or financially interdependent, or you can nominate your LPR. From there, you will have choices as well too. Binding, non-binding, lapsing, non-lapsing, sometimes reversionary nominations as well. These can all be quite confusing. To break it down really simply, binding just means it's legally binding. So if I nominate for my wife to get my super as a binding nomination, it means that the super fund is legally bound to do that. If it's not binding, they're not legally bound, and it can be up to their discretion. Lapsing or non-lapsing, lapsing usually is every 3 years. That means every 3 years, I would need to renew that nomination. If it is non-lapsing, it just goes forever until I change it. So most people will do a binding, non-lapsing nomination, legally binding, and it doesn't change unless I ask it to change. If you are offered a reversionary nomination, that's usually with pension accounts. That just means your pension will revert and stay as a pension for the person that receives it. Again, they're few and far between, but it's important to note that that can be an option as well. So the next few parts I want to go through get a little bit technical. We want to talk about the differences between super, 401k, compliant funds, the tax. These next few slides are probably going to be the most important for our Aussie friends living over in the States, because these are the things that you've really, really got to be thinking about. First and foremost, your super needs to be a compliant fund. What that means is the ATO deem it as a superannuation account and nothing else. So a lot of people with self-managed super funds may fail some tests, and therefore their fund is no longer compliant. That can mean instead of that very friendly 15% tax, you could be taxed 47%. So again, you've got 100 grand there, you make a $10,000 return. Instead of only paying the government $1,500, you have to pay them $4,700. The less money in your super means less compounding, means less enjoyment at retirement, right? The better we can grow your balance, the less tax that we can pay every single year, all the way up until retirement, will have a massive impact on the quality of your retirement. So you need to make sure your super is a compliant fund. Firstly, the sole purpose test. Superannuation is for the sole purpose of your retirement, nothing else. You cannot use your super without a few schemes with first home buyers, but effectively buy a home. You cannot use your super to help your brother do something or help the kids buy their first property or whatever it might be. It's for the sole purpose of your retirement. It needs to pass that test. And the other one needs to be domiciled in Australia. So again, if you do have a self-managed super fund and you're living internationally, straight away that can be a red flag for the ATO to say that you're non-compliant. Try having trustees, directors, maybe a corporate trustee. domiciled in Australia. So the actions of that fund, the central management, the control of that fund, everything happening with that fund is in Australia. You can invest in international assets, but the control of that fund is domiciled in Australia. Doing these type of things will make sure your fund stays compliant and means that you can reap the tax benefits from it effectively. So super versus 401k or IRAs. Really, there are some similarities between the two, but to put it bluntly, they're pretty much chalk and cheese. The main similarities are that they're, for your retirement, they can be a bit tax friendly, but other than that, they're quite different in the way that they work. So we get a lot of questions from our clients living in the States. Should I put more money into my super, or should I put more money into my 401k? And the answer is always, it depends. It depends on you. Are you repatriating in 1 year or 6 years? How much money are we talking? Is it $5,000 or is it 50 grand? It always depends on the specific circumstances of what you're trying to achieve. And this is where I emphasize, get advice, get help, because making the wrong move can really shoot yourself in the foot long term. So superannuation is compulsory. 401ks, IRAs, they are not compulsory. They are your choice. Superannuation is obviously government mandated, so it is a legislative thing that we need to, or employers need to be contributing to superannuation. 401ks can be company sponsored, but again, you can do an IRA on your own as well. Superannuation, you need to be choosing the account. Am I going to have an industry fund, a retail fund, self-managed super? With your 401ks, am I going to go down the path of a traditional 401k or a Roth IRA? There's going to be a few different choices you'll have as well. Generally speaking, for most people, a combination of the traditional and the Roth is a good move. But again, it depends on your circumstances. It depends on how much money you're putting in, how long you're living over there, what you're trying to achieve. Superannuation is preserved, so you can't access it until you meet that condition of release. Your 401k IRAs, you can actually access them at any time. However, there will be penalties if you do so before retirement age. Currently, I believe 59.5. I think that the highest level of penalty will be, obviously you'll pay standard tax, but you'll also get a 10% tax penalty as well too. This can be a big area of contention when people do repatriate and move back to Australia. Do you draw your 401k out? Do you leave it there? What's the differences? What are going to be the impacts? Sometimes it can be better to pay a little bit more tax now if it means it's going to set you up better in the future. So a short-term loss for a long-term gain. Again, it depends on your situation. Again, the super employers must contribute the legislated amount. With 401ks, most employers will match contributions into the fund, but not all of them do. So it's really important to have that conversation, actually see what's in your contract and see whether they're going to or not. $1.9 million is the maximum amount you can have in a tax-free pension account with superannuation. With your IRAs, 401ks, the tax is completely dependent on what type of fund you have, where you're living. Are you still domiciled in the States when you draw that down? Are you in Australia? It's completely dependent on the circumstances, so it's hard to say. And finally, not really super or 401ks, but in terms of the social security side, in Australia, we do have the age pension as a safety net, as a fallback. It is there if you need it. We don't have to pay any extra to receive the age pension through our working life. It's not a great amount of money, but it is there if you need it. In the US, you do have social security. So you will be paying tax on your payslip, 6.2% of personal, and your employer will match that. That will be going to social security, which hopefully the goal is for you to get that later in life. When the time comes, it works off a defined formula, but there are a lot of issues right now with the actual Social Security Trust Fund in America. Effectively, they estimate it might run out of money by 2033, 2035. There's a few different studies. So a lot of people, or especially a lot of clients we work with, we're not factoring in Social Security. We don't look at it. We just pretend if we get it, it's cream on top. But if we don't get it, we need to make sure that we can still support ourselves, because it could be something that there may be some issues with over the next decade or two. But effectively, they're the main differences, right? That's how it works. Now, this next slide is really, really important. When we look at your super fund in Australia, the IRS will see it as either one of two options. They'll see it as either a foreign grantable trust, which effectively is the worst option, or an employee benefit scheme, which is what you're aiming for. When we look at the IRS and how they actually tax superannuation and look at superannuation, to be blunt, it's quite shit. So the tax treaty between Australia and the US was created in the 80s. Superannuation became compulsory in the 90s. So in other words, when this tax treaty was created, superannuation wasn't really a thing. So there are no real specific detailed laws. There's been a few case studies and a few precedents that are starting to change that, but at any point in the future, it could change. So the IRS, the way they look at superannuation can be completely different from you to me to someone else. So you have to get expert help here. Have a really good accountant, have a good financial advisor in your corner, because it can mean thousands, if not tens of thousands of dollars in excess tax that you might not have to pay. So foreign grant or trust, that's what we don't want to be looked at, I suppose, by the IRS. And effectively, it's where you have control, you have power within the fund. So a lot of self-managed super funds will be considered foreign grant or trusts. Employee benefit scheme, that's what we're aiming for. Effectively, it's where we don't have control. So if you invest your super through a financial advisor and the financial advisor is looking after you and looking after the assets, that can be considered as not having control. We have to report your super to the IRS at all times. So it is really important that you, again, have a really good accountant that knows Australian tax laws, knows how super works, but also, knows how the US side of it works too. We can bridge that gap together. But effectively, we want to stay in the bottom where possible. If we are considered, though, a highly compensated employee, there can be extra taxes as well. And I'll go through that next. So, double taxes. Generally, superannuation won't be considered as a passive foreign investment company, so a PFIC, or a foreign grant or trust, but it can turn into these at any point in time. And really, it's at the IRS's discretion. So you've got to be really, really careful. Always report your super. And again, have someone good in your corner that can help you with this. When we look at PFIC and how that works, if your super is invested in passive investments, which are usually pooled investments, ETFs, managed funds, this is what a lot of industry funds will do as well. Hence why industry funds can be really bad. You will pay extra tax on that. And it's not a small amount either. I believe it's the top federal rate. So there can be a lot of extra tax for effectively you doing nothing. And you actually can't access your super until you're 60, let's say. So it means you might have a 20 grand tax bill and you can't draw that money out of your super to pay that tax bill. You're going to have to pay it from the funds in your bank, from other investments. So it's really, really important to get these things right. You want to make sure that when you're investing within your super, minimize pooled investments as much as possible. And that word is really key, foreign. The more that we can invest in US domiciled assets, whether it be ETFs, shares, we can eliminate the essence of foreign investments. So you can actually get Australian superannuation accounts where you can invest in US domiciled assets. The benefit of doing that is we're making sure we're not going to be stung with that PFIC tax. Again, like I was saying before, if you are considered as a highly compensated employee, so a HSC, there can be extra taxes on the growth of the fund as well. Currently, for the 2023 tax year, a HSC, the threshold is $150,000 of income, US. Last year, it was $135,000. Again, if you're HSC as well, there can be limitations on what you can actually put into your 401k too. You might not have the same limits as everyone else. So again, our number one tip here, get a really good accountant, someone in your corner that can help you, that can guide you through these areas of advice. Limit PFIC where possible. Try not to be a foreign grant or trust if possible. And if you are a HCE, there's not too much you can do, but it's really, really important to be aware of it, because if you're not planning for these tax liabilities you're going to have, they're going to sneak up on you and you're going to shoot yourself in the foot. Okay? So building your super. Let's actually talk about growing your super and the ways that we can grow it. Now, really, there's two types of contributions. We have concessional contributions, and these are concessionally taxed. When they go into superannuation, they only pay a tax rate of 15%. Currently, the limit's $27,500 a year, and this includes, though, what your employer puts in. So again, that scenario before, if you make 100 grand, your employer puts in 12, you've got about 15 odd grand that you could also put in yourself as a concessional contribution. you can catch up on previous years as well too. So if you didn't put in the last few years, you can catch up on the last 5 years in total, as long as your super balance is below $500,000. So there's potential there to be doing these concessional contributions and minimizing your tax along the way. The way that it works is when you put that money in, you'll pay 15% tax. However, that money that you put in is a tax deduction on your income, Australian income. So if you put $10,000 in, your Australian income, assessable income, goes from 100,000 down to 90. And again, in that tax rate of 32.5 cents, you're going to be saving a fair bit in tax. Again, though, if you are doing these contributions, they can actually be taxed in the US. So doing these extra contributions, it can be a bit of a double-edged sword. You need to figure out if the actual contribution, if the benefits are going to outweigh the costs. If you're going to save $5,000 tax in Australia by doing this type of thing, but it's going to cost you $6,000 worth of tax in America, it's not worth it. Okay, but again, if you save $5,000 and only cost you $2,000 in America, it could be worth it. You could have that net $3,000 benefit. So there are things to consider here, but concessional contributions can be a great way to reduce your taxable income. We've actually got a few different scenarios up next too. So again, in this scenario, the person's earning $100,000. SG contributions currently at 11%, going in $11,000 a year. They put an additional contribution of $10,000. You can see that their net income drops a little bit, okay, because they've obviously put in that extra contribution. But down the bottom there, you can see they've saved almost $2,000 in taxes. So when we look at concessional contributions, you can salary sacrifice in terms of tell your employer, hey, every paycheck, I want $30 to go out and go into super. Or, every 6 months, can you do this? That's a salary sacrifice. You're foregoing your salary to do that. The other option is you can put it in yourself as a lump sum. And all you've got to do is tell the government, hey, guys, I'm going to claim this as a concessional contribution. Otherwise, it's treated as a non-concessional. Another example here too, this person, they've got rental income, $27,500 a year. So they're an expat. Current tax at that expat rate, almost $9,000 on that income. If they were to make a full concessional contribution of the full amount, $27,500, their assessable income in Australia would be zero. They'd still pay that 15% on that money going in, so about $4,000, but you can see it saves them almost $5,000 in net taxes. So again, concessional contributions can be really, really powerful, especially when you're repatriating. Usually when people repatriate, they're selling assets, things are changing. You might start to have a tax bill in Australia. When you're repatriating, these things can be really powerful. If you're not repatriating, you've just got to weigh up what's the benefit I get in Australia versus the disadvantage I'll get in America. And do those two outweigh each other? From there, we have non-concessional contributions. So non-concessional contributions, contributions that go into super where there is no concession. Right? The money's already been taxed, so it's after-tax money you've already got in your bank account, and therefore they go into superannuation tax-free. So they don't pay any tax when they've gone in. The government's already taxed them, and they will go to your estate tax-free as well. There are a few different types of non-concessional contributions. So we have the standard, which is $110,000 a year is the current limit. We've got the downsizing contribution. This is if you're over 55 and you sell your home, your main home that you lived in for more than 10 years, you can put in $300,000 each. So again, it's an incentive for people leading into retirement to really put more into their super, because that alleviates pressure off the age pension for the government. The government co-contribution, this one's really interesting. You don't actually have to do anything for it, or in terms of filling out any forms, but the way it works is if you've got an income of just below about $43,000 and you put $1,000 into super, the government will put in an extra $500. So it's $500 of free money into your super, but you have to have a lower income. We see this a lot with expats maybe repatriating where maybe one person was like a single income family. The husband was working, but the wife wasn't. These government co-contributions can be really beneficial. And below that too, the spouse contribution. Same scenario. If your spouse makes less than $40,000 a year, you can contribute $3,000 on their behalf, and you immediately get a $540 tax offset. So if I'm on $200,000 a year and my wife is just had a baby, so she's not working at the moment, so she's making less than $40,000 for the year, I can put $3,000 into her super. I will get a $540 tax offset. Obviously, if I'm making $200,000 a year, my taxable income is going to be quite high. The final one is the bring forward rule. Now, the bring forward rule, as you can see at the top with the standard non-concessional contributions, I've put an asterisk. All the bring forward rule is you're doing the standard contributions, but you're bringing forward 3 years of them. So today, I could put in $330,000 into my super as a non-concessional contribution, but then I could not do any more for this financial year or the next 2. And then again, it resets. So there's a lot of strategies here to consider, especially if you've got a lot of money sitting in cash doing nothing. You're repatriating, you want to grow your retirement, maybe you're in your 40s or 50s and you want to start growing your super balance. There are things that you can be doing to be maximizing. It works on a financial year basis. Now, financial year in Australia, July 1 to June 30. Let's say June 15, you put in $110,000, you haven't exceeded that cap. 2 weeks later, July 1st, you can then put in another $330,000. So possibility to get $440,000 into super over the space of a fortnight. So there are lots and lots of options, really, really good for people who have maybe received an inheritance or have a lot of large money sitting in cash, or maybe you've sold a property, these type of things. Non-concessional contributions really need to be considered because it's going to grow your super in that tax-friendly environment. Next, I want to go through investments in super. Now, to put it really simply, you can invest in anything that your fund allows you to invest in. That could be cash, that could be property, that could be the share market, international shares, whatever your fund allows you to. If you're in a self-managed super fund, you can invest in actual property as well. You could buy an investment property, you could buy a business premises, these type of things. So superannuation is not an investment itself. Superannuation is a structure, and that structure holds investments. So when we look at how we're investing our super, you've got to think of a few things. You've got to think of what is the level of risk that I'm willing to take on for the level of return that I'm trying to achieve. So you can see here, risk and return will go hand in hand. The more risk you take on, you're hoping for a higher level of returns, but there's more potential of ups and downs. If you've got 10 grand in cash in the bank right now, you can look at that tomorrow, there's going to be 10 grand there still, most likely. If you've got $10,000 in shares, you might look at that tomorrow, it might be down to 9,500. Could be up to 11,000. It has volatility. It goes up and down. However, defensive assets on the left, will not grow as much over time as growth assets will. Holding money in the bank in cash will not perform as well over 20 years as the share market will, or property will, or alternative investments. So it's really important when you're looking at your superannuation and how it's invested to consider, what is the goal I'm trying to achieve with this money? When can I actually access this money? And therefore, what level of risk should I take on with these investments? And that's known as your asset allocation. So what are we allocating our assets to? Most people growing their superannuation generally will want to have their money into growth style assets. The closer you get to retirement, the more you want to start to step that back a little bit. If you're retiring in next month and we have another GFC type event next week, you're going to be stuffed. You're going to lose a lot of your money. You're not going to recover that back because you're no longer putting money into your super. You're starting to draw it down. So it can have a really long-term negative impact. However, if you're 25 and you can't touch your super for 35 years, you can probably afford to take on a little bit of risk. You can see the graph down the bottom, there's the Australian share market. I guarantee if you had that money sitting in cash for 35 years, you're going to have a much worse retirement than what you would if you were taking on more risk with that money. So when we're thinking about how we invest our super, 4 main things we need to ask. What is the level of risk I'm willing to take on? Are my assets going to be diversified? So am I going to have some in property, some in Australian shares, some in US shares, some in European shares, diversifying those assets. So not all your eggs in one basket. What is my expected time frame? Again, if I'm 25, I've got at least until age 60. If I'm 55, I've only got 5 years until I can access that money. It's a completely different story of what they should invest in. And finally, what is my expected return? What do I expect the outcomes of those to actually do for me? Am I expecting a 7% return, a 10% return? What's the goal? From there, you can actually start to reverse engineer what you would expect your balance to look like at retirement. And then, are you happy with that? Yes or no? Then therefore we can change things. So importantly, play the long game. Okay, we're about growth. We're about that long-term growth. You can see here from this Vanguard graph, it goes for about 30 years. Cash down the bottom in the gray. If you invested $10,000 30 years ago, it'd be worth about $34,000 now. US shares being the top performer. If you invested $10,000 30 years ago, they'd be worth about $176,000. So if you think about that, if you're 40 and you've put 10 grand into your super and you've left it in cash for 20 years, it's only going to grow to $34,000. That's not going to be much for your retirement. That's barely the cost of a flight with the way that they're going at the moment. However, if you were to invest into US shares and Australian shares, property, you were diversifying your assets and you were getting, the best of both worlds, you can see you're going to have much longer term growth. However, you can see with things like the US shares, when we had the GFC, you can see the decline we had, the pandemic, again, you can see the sharp decline we had. So timing is really important. When are you going to start accessing that money is a really key question to ask on, how you should be invested in that strategy you should take on. So accessing your super. What happens when I repatriate? Now, when you repatriate, again, the answer is it depends. It depends on your situation, depends on, the assets you hold there, the assets you hold here, what job you're leaving there, what job you're starting here. All of these things have a really, really big impact on what you can do. The biggest thing that you need to do when you are thinking about repatriating, before you do it, when you're thinking about it, is start to ask some questions. Is my insurance going to still be valid? Am I selling any of my US assets? What's my visa status going to be? What am I doing with my 401k? Do I withdraw it? Do I keep it there? What am I doing with my main residence? Did I buy a property in the States? Am I now going to turn that into an investment property? It was vice versa in Australia. I had a home in Australia that's been an investment that will now become a home again. These questions are really, really important because you can have tax liabilities in America and Australia at the same time. Just because you repatriate does not mean those liabilities disappear. Okay, so you've got to be really clear, really transparent with yourself, ask these questions and get some help. Okay, every single person's situation is different. Okay, when I repatriate as opposed to you, we're probably going to do different things. There might be some similarities, but we're probably going to do completely different things. So if a friend says, oh, I repatriated 2 years ago and I did A, B, and C, you've got to be really careful because that might not be the right move for you. What might be right for you might be something completely different, and you don't want to shoot yourself in the foot. Next, what happens when I retire? So when you actually access your money, like I've said throughout the presentation, superannuation, to access it, we need to meet what's called a condition of release. Okay, the most common conditions of release: reaching age 60, or preservation age for most people, and retiring, ceasing gainful employment, or reaching age 65 regardless of work. So in Australia, once you're 65, you can access your super regardless of what you're doing with work. However, what most people do if they don't work that long, once they turn 60, they retire, they can then access that money. A lot of people confuse your preservation age, so when you can access super, with the age pension age. You cannot receive the age pension until you're 67, but you can access super from age 60 if you retire. They're two completely different things. So you don't need to wait to age 67 to retire. You could retire, if you have assets outside of super, you could retire before 60. Live off those, then at 60, you get your super, and at age 67, you might get some age pension benefits as well. There is something called a transition to retirement income stream as well. So that's where you can still be working, but you can actually get out 10% of your super once you reach age 60 every single year. A lot of people do this to start traveling. They might cut back on work, cut back from 5 days to 3 days a week. They might want to start paying off their mortgage a bit faster. So these can be really good strategies too, to start drawing a little bit of money out and accessing that money and doing things with that money. Okay, so when you retire, though, to put it simply, nothing actually happens unless you take action and make it happen. So your super will stay in that accumulation phase unless you decide to move it over. Just because you finish a job doesn't mean that money automatically moves. You have to complete the paperwork, figure out what you want to do, how you want to invest it. There's all these big questions that you'll need to ask. What most retirees do once they can access their money is start what's called an account-based pension account. We can start drawing down regular income. However, that money becomes fully accessible. So if you've got $1 million in super and you retire, you could start drawing down a pension of 80 grand a year or something, but you can still draw out $200,000 in a lump sum if you want to pay off your mortgage or help the kids or go on a big holiday. Your money becomes fully accessible, but you've got to think now that pool of money you've accumulated is no longer going to be growing with any contributions unless you obviously have money to put in. It's going to start depleting. Okay, especially if you're drawing out a large amount, which means if you live past the expectancy of that money, you're going to be solely reliant on Social Security and the age pension, depending on where you are at that time. Currently, the age pension for a single, I think, is about $27,000 a year. It's not much at all. So the goal is to keep your money invested, keep your money growing, so your money will last well past your life expectancy, and then there's going to be something there for your beneficiaries to take, whether that be the kids or family or a charity. So big things to consider when you retire. What country am I retiring in? Okay. Australian superannuation can be taxed in America. Social security payments won't be taxed in Australia. So it depends on what you're doing, where you're retiring. You will need to start drawing down a minimum amount from those account-based pensions. It increases with your age every couple of years. It increases. Staying invested is really important. Just because you've retired doesn't mean you put all that money into cash. If you do so, you're going to deplete that balance a lot faster. If you've got $1 million, you might put it into something more conservative. Let's say you get a 5% return. That's $50,000 a year. Then you can draw out $50,000 a year. Therefore, in theory, your money stays at $1 million every single year. So staying invested, still getting returns is really important because it means that your money is going to have more longevity. Okay. And again, tax is different in Australia. So account-based pensions over age 60 are usually tax-free for the holder up until a certain limit. And that limit is about $1.9 million at the moment, but it will get indexed as time goes on. So by the time most people retire, it'll probably be a bit higher. So when we move money from accumulation into that drawdown phase, into the pension account, tax-free income, tax-free earnings and gains up to that limit, the transfer balance cap limit, but we want to make sure that we are still investing that money correctly. This is why superannuation is so important. We've done a bit of a breakdown here. If you held an investment property worth $1.9 million, getting rental income of 95 grand a year, you'd pay about $23,000 in tax. If you have that same amount of money invested in super in an account-based pension, you will keep every cent. $95,000 will go straight into your pocket. The government won't take a cent. So holding money in super, and this one, growing your super while you're still in that accumulation phase, is so important. The goal is to get to that transfer balance cap limit at least. You want to maximize as much tax-free income as you possibly can. The only return that matters is your after-tax return. Okay, that's the only return that matters. So we want to minimize tax everywhere that we possibly can. Pay your fair share and not $1 more. Okay, so what are the current opportunities that we're seeing out there? A few at the moment. Firstly, the weak Aussie dollar. So the Australian dollar has dropped quite a bit recently. At the start of the year around February, it was about 71 US cents. Now it's down to about 64 US cents. It's about a 10% decline. Now, if you're still being paid the exact same amount in the States, effectively you're going to get more bang from your buck by transferring some of that money to Australia. So whether that be into your superannuation, whether that be into other investments, the thing is timing can be immensely powerful, especially when we look at currencies. Okay, so really, really important that you're putting this into part of your plan. Do I have excess money lying around? Is there a way that I can maybe put some more money into my super, put some more money into my Australian investments? But we've got to think, what are the implications of that going to be? If I move 50 grand over and put it into super, does that mean I'm going to pay some tax in the US? Probably. So there's a lot of things you got to think about and make sure it's going to be bang for buck, and the pros are going to outweigh the cons. Next is how to actually minimize your tax. So again, these are some really good opportunities that we're seeing at the moment. Concessional contributions, like I went through, they're going to be key. So especially if you're repatriating, these will lower your taxable income in Australia. So great if you've got capital gains bills coming up, or capital gains in that financial year, I should say, sorry, if you've sold assets like property or shares. Great if you've got rental income from a positively geared property. Again, that's all income that's going to be accessible. Great if you've got business dividends or any other taxable income in Australia. Concessional contributions need to be considered. For some people, they're not going to be the way to go. It might be more detriment than good, but for a lot of people, they're going to be really beneficial in not only minimizing tax, that's a benefit of it, but growing your superannuation account as well. If you put $10,000 in, you've got to remember that money is going to then be invested for the next 10, 15, 20, 30 years, however long it is, growing that retirement balance, growing that inevitable tax-free income. Okay, so concessional contribution is really, really strong. And another tip I really want to emphasize, structure your investments in a way that we're avoiding that PFIC tax. Okay, can we invest in things that are US domiciled that don't have that foreign label? Are there ways that we can reduce being a foreign grantor or trust? We've got to think of how we structure these investments in the best way possible to make sure that we're not paying unnecessary taxes, both in Australia and in the US. Okay, so next steps from here, guys, end of the presentation. Really, again, just touching on the way that we work. At the start of the process with LR Wealth, it's completely no obligation, no cost to you. So what we do is we have an initial consultation where we have a chat. What are you looking to achieve? Can we actually help? What are your goals? What are you trying to do? From there, we actually review your financial situation and goals, and we can go through a personalized strategy plan. This is the opportunities you might have in front of you. This is what you should be thinking about. We had a look over your super. You do have a lot of it invested in cash. I've been seeing that a lot quite recently. Is that something that's going to be the right move? You want to do this, you want to do that. Are they achievable? We can do all of that. And it's really, really a fair bit of work from our side with no obligation from you. Okay. At the end of those strategy meetings, we'll pretty much say, this is how we work. This is what we do. These are our fees. Is it something you wanted to proceed with? From there, we then help with the implementation of the financial advice. We present you the advice document. We help with the ongoing support of repatriating, moving, investing. We manage everything from A through to Z. But that initial start of the process, absolutely no obligation. Really, really good if you just want to reach out and see how things are tracking and see if you want to have that bit of a health check on your finances and see how you're traveling. It's something that we're really, really passionate about, right? As I said at the start, it's not something that a lot of people do, this type of advice. So it is few and far between. We're always here to help. So just reach out with any questions you might have. And to finish it off, guys, we do have a few questions that have come through. Okay, so question number one, what should I do if I still have an SMSF and I live in the US? That's a good question. Look, with superannuation accounts, and this cannot be considered as advice, but you can change your superannuation account at any point in time. So I can be an industry fund and roll my superannuation over to a retail fund today. It's as simple as just going on the website and applying, opening the account and doing so. Same as changing banks. Right? You could have $1,000 in your bank with, let's say, CommBank, and you want to change it over to NAB. It's simple as just opening the account and transferring the money. Because superannuation is its own structure, another question that's come through is, will I pay any tax if I roll over my superannuation fund? Yes and no. So with a self-managed super fund, it can be, because you're managing that money yourself, there can be unrealized capital gains. There can be tax. You effectively need to do the tax return for it every single year. When you're in a retail fund, an industry fund, they manage the tax for you. They pay it for you. They do all the reporting to the ATO. You don't have to worry about it. In a self-managed super fund, you are the reporter. You're the trustee. It's your responsibility. So you could, let's say you've got $100,000 in the self-managed super fund in shares. If you were to transfer those shares to another fund, there could be tax on the capital gains. There could be tax on the income. It depends on your situation. If you've got 100 grand sitting in cash, there's probably not going to be any tax. If you hold a property and you need to sell that property to change it, again, there could be tax. Maximum tax rate of 15% though. So again, it's a very healthy tax rate, and it's within the superannuation environment still, so you can roll it over. So if you roll over your fund to another super fund, there can be internal tax, but it's not really a penalty tax or anything like that. It's tax that you would have paid anyway. You have made that capital gain. You have made that income. You have to pay that tax at the end of the day anyway. You're just bringing it forward to transfer. Another question here that's come through, is there a specific age I should really start increasing my super contributions if I plan to retire in Australia? Great question. The answer is we don't want to do things in silo. So we never, like superannuation, I love superannuation. It's a great investment. It's very tax friendly, but there's many other things to consider. Super's great. Holding shares in your own name is great too. Holding shares in a company is great. Putting them in a trust is great. Buying your dream home is great. Helping the kids buy their first car or making sure they can go to the school they want to go to is great. What's your budget? What's your debt management? Are we paying off our mortgage? There's lots and lots of things to consider. And the worst thing that you can do is make a decision in silo. So if you've got 20 grand in the bank and you think, I'm going to put that in my super, you've got to think, how does that impact my debt? How does that impact what I want to do with my kids? How does that impact my budget? How does that impact my personal wealth? Super is a great investment to grow your wealth long term, but you can't touch it till you're age 60. So if you wanted to retire at age 50, you're going to really want to start building assets outside of super as well. So it depends on your situation, but really my advice would be, if you can afford to put money into superannuation, $20 a week, $50 a month, $1,000 a month sometimes, whatever it might be. If you've got the ability to contribute extra to superannuation, you probably should. Because when you add in the effect of compounding long term, that money will grow immensely. Okay, but consider every other option as well too. Another question here, are there super funds that are more US friendly than others? So great question. Effectively, yes, there can be. I had someone actually ask me this on LinkedIn, and I kind of beat around the bush a little bit, but effectively the way it works is you want to have, for lack of a better word, choice, but without no choice in terms of what the IRS deem. They don't want you to be in control. But things like industry funds, because you don't have choice of, if you're invested in the growth fund at Australian Super, you don't choose what those assets are. So they're going to buy and sell assets as they please on your behalf. What that means is you can be hit with that PFIC tax, okay, because it's a pooled investment, it's a passive investment, and it can be a hell of a lot of tax. So industry funds, they can be great when you're domiciled in Australia, but when you're living in the US, you can pay unnecessary taxes. Again, self-managed super funds being foreign grantor trusts, they can be, unnecessary. A lot of, if I had to say US friendly fund, retail funds where you can choose specific investments, you can choose US domiciled investments. So US ETFs, think like Vanguard ETFs and things like that. And again, that's not advice, it's just an example. Things that are domiciled in the US that you can actually invest in, limit that PFIC tax, limit the probability of that fund becoming a foreign grantor trust, limit the exposure you're going to have to possible tax liabilities. So retail funds can be really beneficial in terms of which fund you choose. They all have their pros and cons. Some have better user experience, some have better investment options, some have higher fees, lower fees. I will stress that high fees are not always bad, right? A lot of the time, lower fees mean you're in probably a crapper fund. So don't be scared of paying a little bit more for your super and your investment to get a lot more in return from that investment. Another question, are there some super funds that allow me to invest in US dollar assets? There definitely are. Yeah. So again, US domiciled assets, retail funds are really the area to look there. Cool. Any other final questions at all, guys, coming through? Perfect. Look, I think that might be it. We're pretty much right on time, which is good. I know today was a lot of information, Super 101. It is a complex topic, and I'll emphasize that the thing is, because the laws between Australia and the US were created before super, it's a bit of a Wild Western game. So we don't know what's going to happen in the future. 5 years from now, everything I've just said today would be irrelevant. In terms of foreign grantor trusts, employee schemes, it depends on what the laws do and what they change as time goes on. As we start to live in a more globalized world where more and more expats are moving overseas, if we're making a loud enough voice on these type of things, the IRS might change what they're doing. There might be new laws that get implemented in the States, maybe a new tax treaty between the two countries. These things can change over time. So emphasize, get help, because what you do now and what you do next year will probably be different. Okay, so it depends on so many different factors, so many different variables. But look, we definitely went through a lot today, guys. We are out of time. So what I'll say is, if you have any questions, I'm always here to help. Book in a free initial chat, hit me up on LinkedIn, send me a direct message. I'm always here to help with whatever it might be. Legally, we can't provide advice until you're a client, but we can definitely give general advice and general tips and tricks and things that you need to be considering and thinking about. Okay, perfect, guys. Look, we'll wrap it up there. Jared, sitting quietly in the background. Any final points from you at all?
No, look, I think that's great, Will.
It's a bit of a headache, superannuation. It definitely is a lot to take in for a lot of people. So, decompress what we've gone through today, guys. We'll probably upload the PowerPoint to YouTube as well, too. So if you want to go through and rewatch any parts, definitely do it. And as I said, I'll emphasize, if you have any questions, definitely reach out to me or Jared or the team at RI Wealth. We're always here to help. Awesome. All right, guys. Everyone enjoy the rest of your night over in the States. I'm here in Australia at the moment, so it's only 10 in the morning. So I think I'm going to go have a coffee. Awesome, guys. We'll see you later.